Friends, this is Martin from Sikich, the channel for learning about trading and investing. Welcome to another brand new episode of Markets Next Week, where we look at the weekly stock markets analysis on what happened during the entire previous week and how we can plan for a better trade for the next day. Remember, this is for the analysis for the week that's starting from Monday, tomorrow, February 28th, 2022. So let's get into and see what exactly happened in the markets. So this is where the charts are. So you can see that it's a bearish wide range. Clear bearishness is visible on the Nifty and Nifty also. Clear visible bearishness is seen. This is the weekly charts that you're seeing, right? Left Nifty and right back Nifty. The size of the wick clearly indicates that it has made a recovery after a major dip. Right here also the wick size indicates it dipped and then bounced up. Also we can notice that there is a new swing low that is created. That means the previous swing low was this near to 16,400, which got broken and then it closed above that, but that previous swing is when a new swing low is made. Right? This is what clearly that we can see it at a glance. Now let's analyze what all the additional things. So basically 2.5% of down moves what happened on the weekly basis, right? And actually it was dip was more than that, right? So it was totally 5% of down move that happened, right? So 2.5% was recovered, right, in the Nifty. So it's a wide bearish candle, and it is basically we have lost the 200 EMA support, right? So it is well below that, right? And you can also see that the weekly basis it's an M pattern, right, or a double top that you call. So double top, the neckline for that comes somewhere at the place where the Nifty is closed. You can say that in Bank Nifty also there is a double top, right? But in a slanting way. If you put a trend line like this, right, it can but neckline is not reached. Neckline is in the next swing low, which is not, it has not gone there, but still it is at a previous support zone. This is a resistance zone and it is exactly close to the same zone. So there is so wherever this is a resistance zone where it broke out earlier, which is now acting as a support for Nifty, so there is a CIP bounce chance also on the weekly basis, medium term. Here also this is on a neckline necessary, so naturally it's a place where it broke out earlier. It was a resistance zone, now it is acting as support, and there is its bounce, CIP bounce that can happen from here upside. So there is a double top risk or on a bearishness. At the same time there is a potential change in priority bounce also that can happen at this way. That's, remember, this is on the not on the daily basis, it's on the weekly basis. So Bank Nifty what happened, right? 3% of down, right? Actually 4% recovery happened. So till 7% downfall happened and 4% recovery happened. Finally 3% close from the previous week to week basis. Double top is there. It also, Bank Nifty also lost it 200. DM, day moving average support, and double top M pattern still there. We've seen that, and change in priority bounce also is a potential possible. It's a possibility, right? Daily time frame, if you see, this is what happened. There is a clear trend line. If you draw a trend line at this, like this, right? Any breakout of above the trend line, right? If you draw a trend line like this, that would be the point where we can say that the bearishness is over. Until then, we have the risk of making new lower low or lower high like that. It can market and trend downwards. It's a possibility. Similarly, trend line can be drawn in the Nifty also, joining all the lower low swing lows, right, on the daily chart. So daily you can see that what happened last week was big downfall, big dip that happened for 3 days. One, right, big down of 2 days and then a recovery. Right? That's the price action that happened. So, and another main thing that we have noticed is there is a window gap on the daily time frame. If you see that, you can see that there is a 300-point window gap. In Bank Nifty there is a 600-point window gap. That means the low of the previous candle, this red candle, and this high of this green candle, there is 600-point gap. So that gap is would on price movement on the upside, this gap would turn out to be a major resistance. Same with the MACD also. This is a 300-point range between this previous red candle and this green candle top high, right? So that gap is the first thing that you have to. So any hope of any bullishness would be only after a green close above this 17,500, this 17 to 100 kind of range where the gap is getting filled, and then when the breakout from the trend line that is drawn from top to down like this, right? So that too has to happen for any upside more confirmation. Till then we have the indications on the downside more, right? So Bollinger Bands is saying that, right? Bollinger Band was sideways all these days. No, sideways is over. The volatility expanded and burst out, broke down on the downside on Nifty and Bank Nifty also both. So clear bearishness is indicated, even though a bounce has happened. Unless and until anything goes above the 20 moving average, it still remains expansion on the downside with bearish indications. Right. So this low marking that is put is the gap, the support resistance. So that gap is going to be the major resistance, right? Apart from the previous resistances that is marked here. So first resistance would be 16,700, 750, and then 16,800, 900, which is Fibonacci 38 would be a resistance, and after that 17,000 would be a resistance. That's the end of nearly the end of the gap. So that's a major resistance zone. 17,200 is also major resistance zone. Then above that you have 17,400, then above that you have 17,500, 17,600, which is the Fibonacci 23 resistance, retracement level, which is acting as a resistance. And downside, support would be 16,350 to 16,450, which is Fibonacci 50 retracement. Then you have the gap support of 16,150, 16,200, which acted as major resistance, major support. It's a window gap, very long previous window gap, plus it's a swing low also, new swing low that is made near this. So 16,200 on the downside is a major support, and similarly 17,000 above is a major resistance zone, right? Means clearing the 17,000 is a hurdle, maintaining 16,200 is also crucial. Below that you have 15,800, 15,950, Fibonacci 61. Fibonacci 61 breaking is clear indication of bearishness. So anytime if it's a candle that happens below Fibonacci 61 means it's over. Like it's over in the sense the bearishness is going to prevail for a longer time, right? So this is after 16,200, the previous swing low, the major support that you can see is 15,950 level, which is the Fibonacci 61, right? That's so that is also kind of if at all there is a bearish down pressure is there, that's a point where probably it may it may halt or consolidate at least before thinking of going down, right? So keep a note of this 15,950, 16,200 and 70,000 on the top. So the Bank Nifty also, the gap is indicating the yellow marking, right? So right now the resistance is seen at 36,800 levels, which is also a Fibonacci 38 retracement level. So above that you have 37,000 level, and then Fibonacci 23 retracement, 37,500 level is crucial, then 37,800 is crucial, then 38,000, and then 38,500 levels. So all the resistances on the upside. Then above that you have 39,000 zones, and 39,500 zones, and 40,000 zones. So downside, the first support would be 35,900, near to 36,000. That zone. That's where it started the bounce yesterday, and the swing low that happened on the major downfall is near to 35,000, which is Fibonacci 50 from where it bounced up. So this is also very crucial. 35,300 Fibonacci 50 retracement. Then below that you have 34,750, 350, 750 that zone, and then this is also again a Fibonacci 61%, which is 34,000 level. So 34,000 is very crucial for the Bank Nifty to be maintained on the downside, similar to the 15,950. So keep it clear it. Marking on your charts of this zone 36, 30, basically 34,000 nearby zones, right? That entire zone is very crucial for the Nifty to take support, and because it's a previous zone swing low and in confluence with the Fibonacci retracement 61. Fibonacci retracement 61, as I said before, is crucial. Similarly, the upside, clearing the Fibonacci 23, that is any close above 37,500 is also some kind of recovery, confirmation of no further immediate downfall is what that may indicate. So Bank Nifty, these are the levels too. Nifty, we already talked about the levels. Now momentum and trend analysis, if we come to that, you can see that Nifty is now in bearish momentum on the short term. But medium term, it has managed to, that means weekly charts, if you see, it managed to maintain the sideways momentum. Bank Nifty went to the bearish zones in the short term, but it climbed back the sideways. That way, short term and medium term. Now it is sideways momentum. It is not. Bank Nifty is not in the bearish zones as far as momentum of the price is concerned. Nifty short term momentum is bearish. Now ADX is indicated for the trend. How trending is the market? So it is clearly in the bearish zones, and DMI negative is what you see on the daily and the weekly. That means short term and medium term, it is bearish trend is confirmed by the indicator on the Nifty as well as on the Bank Nifty. Bank Nifty also on the daily charts as well as the weekly charts, it is clear indication that the trend is bearish. And also another worrying thing is the strength of the trend. You can see that here. This is daily. The strength of the trend is rising. It was falling all these times. Now the trend is rising means the bearishness is increasing currently. So DMI negative trend, that is what you see on the Nifty on the left side, Bank Nifty on the right side. Momentum we already seen. It is in the bearish zones for the Nifty. It is in the sideways zone in the Bank Nifty. After it dipped, it made a recovery, and Nifty could not make that recovery yet. Still remain in the bearish zones. So coming to the volatility, that is a big story that happened. 20% of up move happened. It went and hit very close to 34 level of VIX, which is very high. And finally, but it cooled off, and then actually 50% of spike happened, and then 30% it cooled off, and then totally 20% of on the close to close base happened. That 26.7 is where it is. So the fear and greed factor is too much, because of the war, right? So any spike above 20, as I say every time, has to be very cautious because the moves may be too much to handle sometimes. Right? Premiums will be very high, stop losses will make huge losses. So staying away may be an idea by itself, right? Basically. So now VIX has a long, very interesting story to talk about, right? Where the spike of big spike of 50% because of war fear that happened last year, and a cool off after the war has started. Right? Once the uncertainty is over, the volatility crashes, right? And that's exactly what happened, right? So last week is very memorable from the VIX point of view, from the volatility point of view also. Apart from the big downfall of 2.5, almost 5% and 7% in Nifty. Operators also has got a good story. The latest operators data shows if you see Nifty and Bank Nifty both are showing that it is short covering. Short cover is kind of bullish. It means people who have gone bearish until then now have turned to bullishness. And short covering can be sometimes more powerful than long bottom. Right? So that is something that Monday, it may be an indication that it may be a further move up. But that further move would take out the gap is the question, right? So this is we will be looking at the levels for the March 3rd weekly expiry in the next slides, right? So we can also see that the put call ratio is 0.68 and 0.83 on the Nifty and the Bank, which is not bullish yet. Right? Anything above 1 or very close to 1 only, we can say this is bullish. So put call ratio is not showing that too many contracts are bullish in nature. Now look at this, right? So this is only if one day of Friday's trading has happened. So it will be more clear in the in the first 2 days of the weekly expiry. So as of now, the levels, what it indicates is the range that the option writers are going for is at 16,000 put and 17,500. It's a 1,500 range between the put and the call. Right? So highest put writing is in 16,000, highest call writing is in 17,500. 15,500 below that has got also good put writing. Second to the first 16,000, and then 18,000 also has got good call writing. So market sees a very wide range with the high volatility is what of interest is showing. Right? 0.68 short covering, we have seen that. Bank Nifty, the range is 36,000 and 37%. So Bank Nifty, people are not expecting more than 1,000 point of range, right? Based on the highest put and call rating. 35,000 and 38,000 has also got high put and call rating, which may act as support and resistances on the Bank Nifty, right? So those are the levels. Correlate these levels with the markings that we made with on the previous slide of support and resistance, and then that would give you an idea of when to enter, when to exit, and when to position size more or less, all this can be clearly known whenever the price breaches or takes support of at all these levels, right? So this is another way of identifying the support and the resistance apart from the charts. This is support resistance based on the data. Other one is also based on data, but from the charts, purely on the charts. This is based on options data. Coming to sectorial watch, the IT sector, so almost all the sectors closed negative last week. We know that, right? Although a recovery happened, it was not good enough to say that there was a full bounce back. That never happened. It's a hammer pattern everywhere. Hammer is indicative of trend reversal. From the current prevailing trend was downside on the weekly basis. So all the analysis of the sector is based on the weekly. So IT sector is closed down 3%, forming a hammer pattern, and momentum is bearish, and medium term it is sideways, in short term it is bearish. So IT sector just have to wait for the momentum to pick up. Metal 2.75%, auto 3.6%, pharma 2.5%, FMCG 2%, reality 3.5% down. So all down move, between a range of 2 and 3, 4, that range 2 to 4% of downfall is what you see. So this, along with we see that FMCG has got bearish momentum, right? And pharma is sideways momentum, right? Auto also short-term bearish momentum, right? And metal sideways, and IT sector also bearish momentum. So wherever bearish momentum it indicates, so IT is bearish. So half of the sectors, major sectors, if you see, they're all having bearish momentum, while some other halves are going sideways. So we just have to wait for the momentum to catch up before we can take any confident, concrete calls based on the top-down sectorial approach of picking the stocks. Look at the sector analysis. See, it's the same explanation of the charts on what we discussed, right? So this is the weekly charts of each sector. IT sector is showing that overall there is a consolidation happening. Momentum is sideways. Metal sector is consolidation, right, on the weekly basis, and sideways momentum. Auto is again consolidation sideways, and failed attempt to break out with major under resistance on the top. So it's kind of consolidation everywhere that you're seeing sideways. Pharma breaking down, actually not broke down, but maintaining the bearish momentum and maintaining the sideways momentum basically. FMCG also broke down of a major support zone and maintaining the sideways momentum. Reality also is coming towards the major support zone of cup and handles neckline, and then bounce from there. So you can see that it's all hammer everywhere. It's a hammer pattern here, weekly hammer, 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 hammer. So basically what happened last week was a big dip and then a bounce, right? And that hammer could be an indication of a further up move rather than a down move, right? And all are maintaining sideways momentum, and none of them is having bearish momentum on the weekly basis, right? On the daily short-term basis, there is weakness that you can see, right? Now coming to the index heavyweights, it's what you see, right? HDFC Bank is having sideways momentum. It slipped from the major trend line, and on the edge, right? While there is a clear 1545 resistance on the upside. HDFC is also it's like a spinning top on exactly on the major support zone after no continuous fall that happened, except for the previous week where there was an attempt to bounce up hammer, but this week ended up bearish. But maintaining this, actually how HDFC has gone to the on a weekly basis, it has gone to the bearish zones also. But Nifty is maintaining the sideways on the weekly. Now Reliance sideways momentum is maintained well within a channel. Cup and handle may be forming. Infosys consolidating. Small body candles, gravestone, doji kind of patterns are formed continuously. Sideways momentum is it's waiting and watching. That's what it indicates. Consolidating. Kotak Mahindra after breakdown up move and showing good green 2 weeks of up move, right? But the resistance on the upside, at the levels that is indicated. Upwards there are a lot of resistances, but it's closing green, but volumes are less. On a weekly basis, momentum is sideways. TCS is on the edge of this trend line channel, and big bearish downfall is what happened last week. Big, but it has bounced from the major support zone from where it had several weeks before. Also see that there is an M pattern that is formed here, double top pattern, and this support zone where the TCS is there is very crucial that it does not go below that. If it goes below that, it may be indication of a major correction, but sideways movement is what made us medium term. ICICI Bank also is at support zone. It is also having a major support zone, which from where it had an ascending triangle breakout that happened, which failed, and then again it took support there, and then again attempted it, and now again it's back here. So whether it will bounce up and make another attempt to move further, or would it break down and fall down, is what we'll have to see. So it's a very crucial point for TCS and ICICI Bank, I would say. Right? But momentum on the weekly basis for the ICICI Bank is sideways. Now coming to the institutional participation, you can see that the numbers are not updated yet. The total Fyers selling is not updated yet. But just let's so overall you can see all the red here, which clearly indicates that there is heavy selling that happened from the FI side, and a very good amount of buying that happened from the FI side. Let's see the numbers directly on the charts of the FI charts, right? So this exactly happened, right? 4,000 crores of selling on the last day, right? 6,400 crores selling. That itself makes 10,000 crores. This is another 4,000, 13,500 crores, and 16,500, 16,700, and that's so near to 19,000 crores of selling has happened from the FIs, right? Domestic institution, if you see, you can see that the 4,000, 7,600, and it's 11, 15. So equal amount of buying has happened from, and monthly basis, if you see, FIs has been selling. Domestic institutions has been buying 37 crores in February, right, since the month is closed. Now 37,000 crores of buying happened from the, and 41,000 of selling happened from the FI. So the market has not fallen just because of DA that being able to buy big, right? So the point to be noted here is that FI is selling it non-stop, right? The entire February month, January month and all these months it was there. The entire February month, heavy selling, near to 20,000 crores of selling has happened, right? And DAS for some reason has been ferociously buying, with equal pace. One of the days in the previous week it bought more than 7,600 crores in a single day. That's not something that happens very often from the DAS side, domestic institutions. That's the so that's so when would the if I stop this selling spree is what the market should be. The market enthusiast will be watching it primarily, right? So moving on to the global markets, you can see that below what you see is the dollar. It's consolidating again. It had a before dollar index closed 0.5% up. Actually 1.5% up move happened, but it cooled off. That's what you see in an inverted hammer. Inverted hammer sometimes indicates the reverse in the trend. So probably the dollar may cool off a little bit or consolidate, at least is what the indications ahead. USD INR, the chart that you see on the top is well within the channel and maintaining that. It's a major supports resistance zones that it was trying to take out. So 1.5% of breakout happened, but it couldn't sustain and then cooled off. But still at the 75 levels, right? So rupee is weakened last week also, but it cooled off a little bit, and it was about to break out of the 76 kind of levels, when it made 74.5, 6 and all that, but never happened, right? So as soon as the walk started, the breakout stopped. That's exactly what happened. So rupee in a weakened position, dollar strengthening or at still at the top levels and not cooling off much. Um, Crude oil, again, crude oil is at before coming, the crude oil is at crazy levels. It even went to the 100 level last week and then cooled off. So what is the spike? So 9.5% up move happened. Later it cooled off and closed flat, like you see here as a gravestone. This may be an indication that there is every chance that it can now come back down to the 70 levels to the channel bottom on a weekly basis. It's possible because the gravestone doji on a weekly is an indication that for the time being it may be halted. It was met with the top of the channel top also. So, but look at the volumes and look at the momentum and the trend. It's super bullish, and every chance is there to move up, but it may take some call off. But it is still the support zone is what it indicates us. Now gold, the markets were crashing. Definitely attempted to break out with great momentum. Look at the momentum. So there is a chance that there is a range shift from the sideways to the bullish zones may happen now. Right? That's bullish. The gold remains bullish. It attempted to break out of this famous 1917 zone, but failed, and it is cooled off, and now it's a resistance zone. So whether it will take from here on the upside or it will again continue the consolidation is a big question. But the momentum was picked up and gold remains bullish when the market had a big fall last week. Right now, coming to the global markets, that's another interesting thing that happened. Right, across the globe, the markets in back to there is a war, and US market is a mother market. So look at the candle, the wick size. This is a hammer, clear hammer that happened, and clear hammer can be seen in Nasdaq on the top and S&P 500 also. So everywhere it was a big fall, breaking all the major support zone and then recovering and closing above, which is indicating that yes, uncertainty is over now. There is no intention to break down and then go to a bear circle. Is what probably similarly here in the S&P 500 also. This it broke the major support zone that was marked here and then recovered and closed comfortably above that with the hammer. So it's a mixture of what the charts are saying. On a weekly basis, it's saying that it had a big fall last week. There was big panic that happened in the market, but now it may be over, and this there could be a trend reversal that can happen in the is what the market charts are saying. Never know, right? So that's the US markets, the dollar currency, the crude oil, the gold, right? And now let's get into some stock picks. Hindalco is giving that's green close amidst all this panic, and it's well within a trend line on a weekly basis, and with above average volumes and great momentum and great trend. Hindalco long trade. Similarly, Gujarat's Narmada Valley GNFC is having a good rounding pattern breakout. It's taking some time consolidating, so you just need to make sure that the candle close. Look at the volumes, look at the momentum, look at the trend. It's clearly bullish, but it's taking some time to break out because it's a major weekly basis chart. It's a major resistance zone. So once there is a comfortable trending move that begins, when the green close happens above the previous closes, then it's an indication that it's trending up. So just have to wait and watch if you get the trade or not. Right? Great volumes, great momentum, great bulls. There will be some profit booking that may happen whenever this kind of critical zones are there. So you have to be careful. Right? It's okay if you get stopped out also, but have tight stops below the neckline. Right? You may always, if the trend is for real, you may always get a re-entry also. Now this is another index trading strategy that can be applied. It's having good probability of profit and good range. It is giving 15,400 to 17,300. Its downside is more or less well protected for just 5 days of training, 4 days of trading that's left. Position sizing can be based on what is your risk appetite and capital size. But look at the probability of profit, right? And look at the range. Right? Risk reward is also reasonable. There's a double diagonal calendar spread basically with risk defined, and you exactly know how much you lose most. You don't have to lose that much, right? You can either, whenever the market is falling against, and reaching the upper point where the selling has happened, then you can shift and you can roll up and roll down and then adjust it, or you can exit at the loss at that time or a fixed percentage of loss. But make sure that you don't carry to the end of the expiry, and whenever we get 2% of profit, just come out, right? It's purely risk defined, so nothing to worry. You know exactly what you're going to lose, right? You have a plan when to adjust, and what is the max limit of the loss. So it's much safe than playing a naked option. Even if there is a gap up, you know exactly what can happen. You know what adjustments has to be done, right? So everything is clear in risk management strategy. So this is something that we could work out. Only the summary of the Nifty graph that is put, Nifty charts that is put in once again, just to show that there is a clear trend line channel that is there, right? The market is moving down in a trend line. So as long as this breaks out and closes above the 20-day moving average, we can say that there is the chance of further up move. Until then, it's downward move, zigzag. So it may be going up, facing resistance, coming down, going up. And also, I just wanted to show that this major Fibonacci 61, 50, 950 kind of level is very crucial. That so there is a chance that even if it goes down in some point in time next week or the next week next to that, it may find a support here and then bounce up. So, and also to show that it's kind of an M pattern on the weekly basis. If you see, it's clear M pattern that is getting formed, and the neckline of that again will come to you can take this also as a neckline. The previous swing of 16.4, or this also can be a neckline on a bad basis. This support is very major resistance level, right? So keeping that in mind, market overall view for the next week is moderate bearishness, and 200 EMA is gone. Neckline support of weekly double top, downside volatility breakdown. All this gives an indication that it's moderate bearishness is what the charts are telling to me. It may not. It may happen. That's up to the markets to decide. But charts are saying as of now it's bearish. This market had shown clear bearishness. Sometimes same time it had bounced up clearly and said that you're not going to go down. Of course, the market had fallen. The war fear was there. It went down, but there were buyers there, and then it has bounced up clearly above the major support zone. So this market is not ready to fall. It's not in a way where it's going into a bearish zone immediately, but there may be consolidation and some volatility when the inflation, Fed interest rate hikes, all this war, all these things comes. There may be fear, but if it is a big downfall, then it would not have bounced like that. It gives a hope. Or the chart is saying that not ready to give up in spite of this all the negative news that is floating around the last week. Right? Now, crude is shooting up and rupees weakening, so that is a concern. Is adding fuel to our markets. So war crisis, Fed interest rates, inflation, all this combined with crude oil makes it difficult situation. But still, there is strength that can be seen. Positive factor is that market is still showing some strength, although the volatility is that swing lows are broken. All of this, in spite of that, BANKNIFTY is not broken the previous swing low, right? Yeah, so fear and greed clearly is indicated in the wicks. Wicks are short up, so premiums will be very high when you're playing the options. So you have to be very cautious when you are risking your money on that. So basically, Fibonacci retracement levels of 15,950 is very crucial, as I said, and above 20 DMA close is also very crucial on the upside. So these two things you have to make in mind if you are a positional trader, basically. So on net risk, if you are taking, always take the hedge positions and non-directional strategies or vertical spreads or counter spreads, right? Like what I had given as an example of potential trade for the next week, right? So high volatility is there. Remember that it is 26 above is where the VIX is right now. So fear is not fully settled. War is still going on. So anything can happen. So be cautious. If you're not a professional trader, stay away. And if you're trading, also cut short your position size and play safe with overnight risk hedged with option strategies. And so right. And I hope this helps you to frame your view for the next week, right? In some way, and also your trade plan. So if it helps you in any way, consider hitting the like button and share to maximum people. We need more subscriptions, as it's a shamefully low level as of now, and very encouraging to on any help from the few of you who are watching this, right? So please do subscribe and share with us. Thanks for watching. Happy trading, happy learning. Bye.